Welcome to the Deep Dive, where we take your sources and extract the most important nuggets of knowledge to help you become well-informed fast. Today, we're diving into a topic many find, well, a bit daunting, but also incredibly fascinating. How to begin stock trading. You've sent us a really comprehensive guide, and our mission today is to cut through that complexity. We want to equip you with a clear, step-by-step roadmap so you can navigate the stock market with more confidence.
It's true. Yeah, many aspiring traders face a pretty steep learning curve. It's easy to feel overwhelmed by all the jargon, the different platforms, the strategies. But honestly, with the right foundational knowledge, preparation, and approach, anyone can enter the space. So we're going to unpack the essentials today, really focus on what you need to know to get started smart, and crucially, how to manage the risks involved, because there are risks.
Absolutely. So before you even think about buying a single share, the guide you shared really drives home this point, that the first crucial step is, surprisingly maybe, to understand yourself. What does that self-awareness really mean for someone just starting out?
Right, this is where it gets really insightful, I think. Your trading style. It isn't just a preference, it's intrinsically tied to your personality, your comfort level with risk,
Yeah.
how much time you can realistically commit, and what your financial goals actually are. There really is no one size fits all. And trying to force yourself into a style that doesn't fit, that's a common pitfall. So, for example, you've got day trading. As many probably know, this means opening and closing positions within the same trading day. It demands a high time commitment, often, constant attention, and it comes with high risk because of volatility. It moves fast. Now, while it sounds intense, what our sources highlighted is that sustainable day trading isn't just about speed. It's actually about rigorous pattern recognition and extreme emotional discipline. Many successful day traders apparently spend more time reviewing past trades than actively placing new ones.
Oh, that's a fascinating perspective. So less pure reaction, more analytical rigor behind the scenes. Okay, what about options for those who maybe prefer a bit more breathing room?
Absolutely. So then there's swing trading. Here you hold an investment for a shorter period, typically days to weeks, maybe even a few months sometimes. This style involves a more moderate time commitment and moderate risk. You're basically aiming to capture those short to medium term trends you see forming. It's less demanding than day trading, certainly, but it still requires active engagement. You have to keep an eye on things. And finally, there's position trading, which many people think of as long-term investing. Here, you hold investments for a significant period, several months to years or even decades. This usually has a low time commitment and low to moderate risk. The focus is really on those big long-term trends. It requires considerable patience. So this raises that important question, which one truly aligns with you? If you're generally risk averse or you just don't have hours every day to watch the market, day trading probably isn't the best fit.
Right. And the key takeaway from the material you sent was that your preferred style might actually evolve as you gain experience or maybe your life circumstances change. It's not set in stone, which I think is probably a relief for new traders to hear. Okay, so now that you've got a clearer picture of maybe your own trading personality, the next logical step in this journey, as your guide highlights, is finding the right tools. It's kind of like picking the right vehicle for your journey, isn't it?
Precisely. Yeah, brokerages offer different features, different tools, and what's suitable for a day trader might be completely unsuited or just not ideal for a long-term investor. For day traders, for instance, platforms need quick speeds, low latency, that's the term. They need real-time data, advanced charting abilities, those are paramount. They often benefit from specific tools like level 2 quotes.
What are level two quotes exactly?
Good question. They show detailed order book information. So you see the buy and sell orders at different price points. It reveals supply and demand. And they use things like hotkeys, keyboard shortcuts for lightning fast order execution. Examples: Interactive Brokers, TradeStation, TD Ameritrade's Thinkorswim platform are often mentioned.
Okay. And for those with maybe longer horizons, swing or position traders, what should they prioritize?
Right, for them, they benefit more from a wide range of technical indicators, robust research resources, tools for fundamental analysis, comprehensive risk management features. Those become more important. Mobile trading apps are also incredibly useful for just monitoring positions when you're on the go. Brokers like Charles Schwab, Fidelity, Robinhood, E-Trade are often well suited here, and many of them emphasize commission-free trading for most stocks and ETFs, which is, a huge bonus these days.
Definitely saves on costs.
For sure. And for, say, long-term investors or even brand new traders looking for a more hands-off approach, a brokerage with a strong educational component and a really user-friendly interface is key. Make it easy to learn. The sources also introduce robo-advisors like Betterment and Wealthfront. These are for folks who prefer a more automated approach to managing their portfolio. And a fantastic tip for everyone, really. Many brokerages offer free demo accounts. Paper trading. This lets you practice trading with virtual money. You can build confidence, test strategies, all before committing actual capital. Highly recommend that.
Okay, that makes perfect sense. A try before you buy approach. So once you've identified your ideal broker, it's time to open and fund the account. It seems pretty straightforward on the surface, but what are the key steps people need to navigate?
Yeah, the process is usually pretty quick, often just minutes online. First, you'll provide personal info, name, address, social security number, date of birth, standard stuff. This isn't just red tape. It's legally required for identity verification, fraud prevention, KYC, know your customer. Second, you choose your account type. Individual, joint, maybe an IRA for retirement savings, depends on your goals and tax situation. Third, you complete the online application. This might include questions about your job, income, trading experience. This helps the brokerage comply with regulations and sort of assess your risk tolerance, especially if you're applying for things like margin trading, which involves borrowing. And please actually read the terms and conditions. I know, but it's important.
Good advice, even if it's the bit everyone skips.
Yeah.
And then the exciting part, funding it. What are the common ways to do that and any potential catches?
Exactly. You got to put money in before you can trade. The most common methods are bank transfers, ACH transfers they're called. Usually take a few business days for the funds to clear. Wire transfers are much faster, often same or next business day, but they usually come with a fee from your bank. And the slowest method is, believe it or not, sending a physical check by mail. It's also really important to check for any minimum balance requirements for the account and potential maintenance fees. Some accounts have them, some don't. Always be clear on how much capital you actually need to get started and keep the account active.
Okay, so you've got your style figured out, your platform picked, your account funded, check, check, check. Now for the really exciting part, actually deciding what to trade. The guide you shared really emphasizes the power of combining different analysis methods, not just picking one.
Yes, and what's fascinating here is how these different analyses truly suit different trading styles, but also how combining them gives you a much more robust picture, a fuller view. So, for instance, fundamental analysis. This is generally best for position traders and long-term investors. It involves evaluating a company's its financial health, its competitive position, its growth prospects. You dive into financial statements, the balance sheet, income statement, cash flow. You're assessing profitability, debt levels, liquidity, looking for consistent and growing earnings, ideally. You'd also consider the broader industry, the company's market share, the strength of its management team. It's about the underlying value.
So that's looking deep into the company itself, the bigger financial picture. What about technical analysis then? That always seems to be about the charts. Right?
That's right. It's often employed more by day traders and swing traders. It involves studying past price movements and volume data to identify trends and patterns. The underlying assumption is that history tends to repeat itself, or at least rhyme. So this means looking for common chart patterns, maybe a head and shoulders pattern, which often signals a potential trend reversal, or things like triangles and wedges that might indicate consolidation before a price breakout. You also use tools like moving averages. They smooth out price data to show the trend direction more clearly, and momentum oscillators like the relative strength index, the RSI. That helps you spot if a stock might be overbought or oversold.
Interesting. So two very different ways of looking at a stock.
Very different. And then there's news and sentiment analysis, which is really crucial for everyone, regardless of style. This involves monitoring things like earnings reports, listening to earnings call transcripts, paying attention to management guidance, analyst ratings, and also broader geopolitical or macroeconomic events. Think about how, say, an interest rate change or a global supply chain issue could impact markets.
Right, the real-world context.
Exactly. And crucially, your sources remind us again about diversification, spreading investments across different sectors, different company sizes, maybe different geographic regions. It helps manage risk. It doesn't guarantee profits, of course, or eliminate loss, but it can cushion against single-point failures. And finally, maybe the most important point, continuous learning. Research and analysis isn't a one-time thing. It's an ongoing endeavor. You should constantly be reading financial articles, books, staying informed on market trends.
So what does this all mean for you, the listener? It's definitely not a set it and forget its task. It's about refining your methods, regularly reviewing your portfolio and your reasoning. The market is always moving, always changing, and so should your understanding of it. Okay, with your research done, it's finally time to make a move. The guide delves into different order types, which seem pretty critical for, effective execution, getting what you want.
Yeah, this raises that important question. How do you actually tell your broker exactly what you want to do? You'll specify the stock ticker symbol, the number of shares, and critically, the order type. The simplest are market orders. These execute at the best available price as soon as possible. They get filled quickly, which is great when you just want to get in or out of a position immediately. No messing around. But, and this is a big but, in fast-moving or illiquid markets, you risk getting an unfavorable price, sometimes significantly different from what you saw just a second before you clicked. That's called slippage.
Ah, okay. So quick, but potentially less control over the exact price you pay or receive. How do you get more control then?
Precisely. For more control, you use limit orders. With these, you set the maximum price you're willing to pay if you're buying, or the minimum price you're willing to accept if you're selling. They give you far more control over your entry or exit price. But the trade-off is they don't guarantee a fill. If the stock never reaches your specified limit price, your order just sits there unfilled. These are incredibly useful when you have a specific price target in mind and you're not willing to deviate.
Got it. Market for speed, limit for price control. What about stop orders?
Right. Stop orders are primarily for risk management. They are triggered when a stock reaches a specific price, your stop price. Once triggered, they typically become a market order to close your position. So they're designed to limit losses if a trade goes against you or protect profits if a trade has moved in your favor. However, a caution, like market orders, in very fast markets, your stop order could still fill at a price different from your stop price due to that slippage effect.
Okay, that makes sense. It tries to get you out near that price. Now, this is where it gets maybe a bit more complex. The guide also mentions time and force options. These sound like they determine how long your order stays active.
Exactly right. They specify how long your order remains active in the market before it expires if it's not filled. The most common ones, and probably most useful for a new trader, are day orders. These expire automatically at the end of the current trading day if they haven't been executed. And the other main one is good till canceled, or GTC. As the name suggests, this order remains active day after day until you actively cancel it or it gets fully executed.
So if I want to buy a stock only if it drops to a certain price, and I'm willing to wait days or weeks.
That's exactly where a GTC limit order comes in handy. It ensures your order doesn't just disappear at 4 p.m. every day. There are other more specialized options too, like immediate or cancel, IOC, all or none AON, fill or kill, FOK. But those are generally used in more specific, often higher frequency trading scenarios. Day and GTC cover most needs initially. And importantly, our sources really stress this. Double check everything before you hit that submit button. It sounds basic, but it's crucial to avoid costly mistakes. Confirm the ticker symbol is correct. Confirm the number of shares. It's remarkably easy to add an extra zero.
Oh yeah, I can see that happening.
Confirm the order type, the price, if it's a limit order, and be aware of any associated commissions or fees. A simple typo can be painful.
Absolutely. Okay, this next section seems like maybe the ultimate step, the one that can really make or break a trading journey. The guide you sent us really emphasizes that risk management isn't just, a suggestion, it's presented as an absolute must.
It truly is. Knowledge is most valuable when it's understood and applied, and this is where it matters most. Effectively managing risk protects your capital, it limits your losses, and fundamentally it improves your overall performance, making trading sustainable over the long run. We mentioned diversification earlier, spreading investments across different stocks, sectors, asset classes. It reduces the impact if any single investment performs poorly. Again, it doesn't guarantee profits or eliminate loss entirely, but it definitely cushions the blow if one part of your portfolio struggles.
Right, not putting all your eggs in one basket. Makes sense. What about the human element, though? The psychology of it all?
Oh, that's absolutely crucial. Emotional discipline. This is huge. Fear and greed are powerful emotions, and they can significantly and negatively affect your trading decisions. Fear might cause you to exit a winning trade way too early, leaving profits on the table. Greed might make you hold on to a losing stock far too long, hoping against hope it will turn around, leading to bigger losses. It's absolutely essential to define a trading plan before you enter a trade and then stick to it, no matter how intense the market swings feel in the moment.
Easier said than done sometimes, I imagine.
Definitely. And that links into position sizing. This is fascinating. It's about controlling the number of shares or contracts you trade in relation to your total account size. A general rule of thumb highlighted in your sources is to risk no more than, say, 1% to 2% of your entire account capital on any single trade. This disciplined approach helps control your exposure. It prevents one single bad trade, and they will happen from wiping out a significant chunk of your capital.
That's a very concrete rule, 1 to 2%. But, for someone starting with a smaller account, that might feel almost insignificant per trade. How do you balance that crucial risk management with the desire for, well, meaningful returns?
That's an excellent point, and it's where the risk-reward ratio comes into play. This isn't just some abstract number, it's a fundamental principle that forces you to think defensively about every single trade before you take it. You actively compare the potential profit you realistically expect from a trade to the potential loss if you're wrong, where your stop loss is set. A common target ratio mentioned is 1 to 2, meaning you risk $1 for the potential to make $2. This structure ensures that even if you're only right, say, 50% of the time, your winning trades are larger than your losing ones on average, which means you can still be profitable overall. That focus on asymmetry is a game changer for long-term consistency.
Right, so your winners pay for your losers and then some.
Exactly. And that brings us back to stop-loss orders again. We mentioned them for order types, but they are crucial risk management tools. They automatically trigger an order to close your position if the stock price hits a preset level you define. This directly limits your loss on that trade and protects your capital from further downside. It takes the emotion out of closing a losing trade.
Is that the main type? Just a fixed stop?
There's also a variation called a trailing stop, which is quite powerful. A trailing stop automatically adjusts upward as the stock price moves in your favor, but it never moves down. So it effectively locks in profits as the trade works, while still limiting your potential loss if the price suddenly reverses. It trails behind the price action.
Ah, clever. So protects profits too.
Yes, and if we connect all this to the bigger picture, risk management isn't a one-time setup, it's an ongoing process. You absolutely must regularly review and adjust your strategies. As your skills develop, as your life circumstances perhaps change, as broader economic conditions shift, your risk approach needs to adapt too. It's dynamic.
It really sounds like a continuous learning loop. Assess, plan, execute, manage risk, review, adapt, repeat.
That's a perfect summary.
So what does this all mean for you, the listener, as you embark on this journey? The guide wraps up with some really helpful distinctions and also traits of successful traders, things to keep in mind.
Yeah, this raises an important point. Understanding the subtle but important differences between related concepts, and also thinking about what truly makes a trader effective beyond just the mechanics we've discussed. First, that distinction between trading versus investing. We touched on it, but it's worth clarifying. Investors are generally long-term, sort of buy and hold market participants. They're focused on capital appreciation over years or decades. Think Warren Buffett. Traders, conversely, buy and sell shares much more frequently. They're hoping to make shorter-term profits from price fluctuations, maybe over days, weeks, or months.
Different time horizons, different goals.
Exactly. Then there are common trading strategies. The guide briefly lists examples like following the trend, basically buying into upward movements or selling into downward ones. Contrarian trading, which involves deliberately betting against the prevailing market sentiment. Going against the herd. Scalping, that's trying to make very small, quick profits on tiny price changes, often many times a day, very high frequency. And trading the news, reacting quickly to economic data releases or company announcements.
Okay, lots of different approaches there too. And the analysis types, again, technical versus fundamental. How do they fit?
Yes, just to reiterate that link, technical analysis, looking at charts and patterns, tends to focus on the short-term picture. So it's ordinarily seen as better suited to shorter-term trading styles, helping identify entry and exit points based on price action. Fundamental analysis, conversely, takes that longer-term view, evaluating the company's underlying health and value, making it generally more aligned with investing, though traders certainly keep an eye on fundamentals too, and vice versa.
Makes sense. And finally, what about the personal traits? What does it take beyond just knowing this stuff?
Right. For the traits of a successful trader, your sources really emphasize that beyond the necessary knowledge and experience. Discipline and mental fortitude are absolutely key, maybe even more important over time. Discipline is needed to consistently stick to your chosen strategy, especially your risk management rules, like cutting losses quickly. It prevents small setbacks from escalating into account-crippling disasters. And mental fortitude, or resilience, is essential to bounce back emotionally and strategically from the inevitable setbacks and losses. Losses are a part of trading. How you handle them is critical. And it's noted that true trading acumen, that intuition and skill, really develops over years of practice and learning, not weeks or months. Patience is vital there too.
Wow. What a deep dive indeed into the world of starting stock trading. We've covered a lot from finding your personal trading style, which seems so foundational, to setting up accounts, researching wisely, using different methods, placing orders correctly, and then, critically, managing that risk with discipline. It's clear that starting your trading journey is really about first bringing yourself up to speed on how financial markets work, then diving into company fundamentals, learning to read charts, and truly understanding price action at risk.
Indeed. And while we've outlined, a robust six-step guide based on your source material, it's really vital to remember that stepping into the stock market isn't a destination you arrive at. It's very much a continuous journey of learning and adaptation. Markets are incredibly dynamic. They're constantly shifting with new information, economic forces, global events. So for you, the ultimate provocative thought, maybe, for your own exploration is this. How will you commit to that continuous learning? How will you evolve your approach over time? How will you ensure that every trade you make isn't just an execution, but also a genuine opportunity for growth and for refining your understanding of the market and yourself?